Recently, the price of gold crossed 55,000 per 10 gram for 24 karat gold. Here is the chart which is showcasing an unanticipated rise of gold recently. This is leading to a question of why the gold price was increasing significantly during this pandemic time. Let us understand a brief history of gold and its prices. The modern day history of gold dates back to 1944 in Bretton Woods Conference when 44 allied nations established an international fixed exchange rate system pegging the currency to US dollars, convertible into gold at $35 per ounce. It was the same conference when two institutions, the International Monetary Fund and the World Bank, were formed. In the next 30 years, because of the increase in imports by the United States, the country had to finance it by printing more money. The gold reserves of the Fed, the central bank of the United States, became insufficient for converting dollars, leading to devaluation of the dollar. Therefore, on 15th August 1971, convertibility of dollars into gold was suspended. This was the end of the United States' commitment to set a fixed price of gold, making the dollar effectively a fiat currency, that is, not backed by any commodity like gold. In the next 5 years, the United States devalued the currency several times, and finally in 1976, the Jamaica Accord recognized this situation and ended any reference to gold in the international monetary system. That is, end of the Bretton Woods monetary system. In practice, the dollar had been floating in this way, but it was official in Jamaica Agreement. Today, the currencies are not pegged against any commodity. The gold prices fluctuate according to international prices, that is, demand and supply. Every year, the amount of gold mined is not very high, and so if the demand for gold increases, the price also increases. Dollar rupee exchange. As the gold is traded in USD in the international market, the exchange rate affects the gold prices. Import duty on gold. India is the world's second largest consumer of gold after China, and it imports 99% of the total consumption, as mining of gold in India is not feasible and profitable. Therefore, import duty also plays a significant role in gold prices. Interest rates. Gold prices have an inverse relationship with interest rates. When the interest rates fall, people don't get good returns on their deposits. As inflation-adjusted returns on bonds turn negative, investors feel comfortable owning gold as a store of value. In the current scenario, the bond yields near zero in the United States and negative in Europe and Japan. Therefore, investors have started buying gold. And Fed officially have also signaled that they are not thinking about raising rates in the near future. Generally, it is seen that gold prices and share market are negatively correlated. That is, if the stock market falls, people start investing in gold, thereby increasing its prices because gold acts as a safe haven. Investing in gold is considered to be an ideal hedge in a volatile market. But serious investors have a belief that gold as an asset does not bring much return because the commodity price rise and fall in cycles, gaining nothing in value over time. Just like it surged after the 2008 financial crisis to $1,900, but then it slid backward. Over the past century, the price of gold adjusted for inflation has risen by an average of just 1.1% a year only. But as the economies globally are recovering from the lockdown and Russia announced coronavirus vaccine, this led to profit booking and sharp decline in gold prices. Societies and economies have placed value on gold, thus perpetuating its worth. But many people still argue that gold, a mysterious metal, has no intrinsic value. Thank you for watching the video. I hope you find this video informative. Do subscribe to my YouTube channel, Finowens.